Hello, everyone. Matt Clark, research analyst for Money Markets here with your weekly Bull and the Bear podcast. Now, if you have not already, I want to make sure that you are subscribed to our YouTube channel. That's where you're going to find a lot of great features with Chief Investment Strategist Adam O'Dell, Green Zone Fortunes co-editor Charles Sizemore, and myself each and every week. If you're not there, head over to youtube.com, type in Money and Markets in the search bar. You'll find our green Bull and Bear logo. Just make sure you click on that. When you get to the page, hit subscribe and then mash that notification bell, and you get notified each and every time we release a new video. Now, I'm going to move on with today's podcast. Got a lot of ground to cover. Today, I'm going to show you a trend that I've uncovered in the retail sector and give you a way to play it so you can maybe look at some strong profits heading into the holiday season. Now, for a little bit of context, we are heading into the holiday season here very, very quickly. I didn't even realize that we were this close to Thanksgiving, but here we are. And one thing is going to be on millions of Americans' minds, and that is what gifts to buy for Christmas. These pivotal next 4 to 5 weeks are critical in the retail industry. Large amounts of money are going to be spent from just before Thanksgiving, coming up here in just a week, through Cyber Monday and on to Christmas Eve. And this year has the potential to be explosive in terms of holiday shopping. Now, a decade ago, Americans spent about $553.3 billion during the holiday shopping season. It's not a bad amount, about $500 million. And that was up from only around $400 billion 20 years ago. Now, last year, even despite the COVID-19 pandemic and as we try to ease out of lockdowns and things like that, Americans spent $777.3 billion during the holiday shopping season. Now, an annual survey just put out a few weeks ago by the National Retail Federation suggests that holiday retail sales will hit $843.4 billion in the U.S. this year. That's an 8.5% increase from spending in 2020. But it goes deeper than that. The U.S. retail sector has suffered massive hits throughout the COVID-19 pandemic. Monthly sales plummeted by more than $100 billion in 1 month at the height of the coronavirus lockdowns. It forced stores to shutter and even some big retail chains to be pushed towards bankruptcy. But those sales have roared back after the pandemic has started to subside. The retail sector suffered a lull in sales during the spring and summer months of this year after bouncing back from a disastrous 2020. And analysts projected that the stagnation was going to continue into the fall as the Delta variant of the COVID-19 pandemic started to pick back up across the globe. So it came as a pretty big surprise to analysts as monthly retail sales ticked up in both August and September. But analysts still believed that the increase was short-lived. Remember, 2 times is a coincidence, 3 times is a trend. So when October rolled around, monthly sales figures, which came out earlier this week, they were released. It shocked everybody. Monthly retail sales topped more than $638.1 billion, shattering the previous monthly record of $628.7 billion set back in April. It also marked the 3rd consecutive month where retail sales moved up. And this signals a trend. Now, to add some perspective, we can look at month-over-month percentage increases in retail sales to get a little bit better perspective here on what we're talking about. If we break that down into seasonally adjusted monthly percentage changes, this is basically taking the amount from 1 month to the next and figuring out what the percentage change was. October was only the 6th month since 2016 that sales jumped 1.9% or higher. Let me add another layer for you. It was just the 13th month where sales increased by 1.9% or more since, get this, 1992. In that time frame, only 13 months have sales increased 1.9% or more. In fact, I believe, if memory serves, this was the 2nd highest increase in the month of October since 1992. Inflationary price growth of 0.9% in October, it can account for some of the gains in retail sales, but it doesn't account for all of it. And it also means that consumers aren't closing their wallets because of higher prices and inflation. It sets the stage here for a very strong potential 4th quarter for the retail industry. And I found a way where you can get in on this trend now and add profits to your portfolio during the holiday shopping season. Now, the VanEck Retail ETF, which trades on the NASDAQ under the ticker RTH, is an exchange-traded fund that invests in growth and value companies in the retail sector. Some of its holdings include Amazon.com, Home Depot, Costco Wholesale, and Target. So it encompasses both traditional retail and online retail. Now, this year started down for the ETF as retail sales kind of faced those inflationary headwinds that we initially saw and then picked back up, which caused some very flat trading during the summer months. But RTH dropped to a 52-week low of $149 a share in the first part of March. It rebounded nicely, and has recovered and sits 31% off that low and is up 27% from 12 months ago. It hit a new 52-week high this week, and it's showing that maximum momentum that we look at for a stock. Now, in the last 4 weeks, the ETF itself has moved up 6.8%. Compare that to the S&P 500 gain of just 4%. Now, it's not huge, but again, anytime you can beat the market, that's a win. Additionally, the ETF comes with a nice annual yield of about 0.51% or about $1 per share. It's not huge, but again, it's a nice bonus for a stock that's already in an uptrend. So to put it all together here for you, retail sales are up, and the holiday shopping season coming up is expected to set new records. That tells me that the Van Eck Retail ETF is a great way to play this trend. Now, one other thing I want to point out here, I want to reflect back a little bit on last week's podcast. I told you that it was time to sell, if not partially, all of your positions that you had in Activision Blizzard, which trades on the NASDAQ under ATVI. Well, if you did, the timing could not have been any better. I told you the company was already slumping, and the delay of 2 of its massive title releases was going to have a negative impact on its holiday sales, thus push the stock lower. Well, since the podcast, ATVI stock has dropped nearly 6% after allegations surfaced that CEO Bobby Kotick engaged in mistreatment of female employees and was unaware of years of sexual misconduct, including rape, and did not report it to the board. So that 6% drop in Activision's total decline off its February high is now 36% down. So that's a big drop. If you got out of it, if you took the recommendation and got out early, congrats. Then you can preserve some capital and move that possibly into the Van Eck Retail ETF that I just told you about earlier. Now, I want to look at last week's poll question. We did ask you, if you did own a video game stock, which would it be? And a majority, around 44% of you, said you would own Roblox Corporation, trades on the New York Stock Exchange under RBLX, recently came out on the market not too long ago. While another 33% of you said you would actually own Activision Blizzard. Maybe not so much now, but then maybe so. Around 16% of you said you would actually own GameStop, which trades on the New York Stock Exchange under GME. And 8% of you said the video games were really just a waste of time and money. And we also asked for your insight into why. Pizza Mine 98 on YouTube said Blizzard, because they have a very monetizable demo that they attract with Hearthstone and World of Warcraft, which is basically the demo that they're talking about is the 15 to 35-year-olds, and they're less volatile. That was up until about late last week, early this week. Now they are. And as I said, after the recent allegations, Blizzard is now down 36% off its February high, and release delays are not going to make things any easier for this company. Now, thank you to everyone who voted and commented on our poll. We do them every week, so make sure you check back and vote on our YouTube page. We do these polls, and they're right under the community tab right there on YouTube, so check all that out. If you have a particular question, or maybe there's a stock or a sector that you'd like myself or Adam or Charles to take a look at, very easy to do that. All you have to do is just email us at feedback@moneyandmarkets.com. We're going to put that down below there, feedback@moneyandmarkets.com, or you can comment down below here on YouTube. If we do use your question and we use it in any of our videos, we're going to get you set up with some Money and Markets gear. This could include t-shirts, hats, sweatshirts, a wealth of things out there that we could get you hooked up with to show our appreciation to you for being involved in our community. And more importantly, what I'd love to see is if anyone wants to video themselves asking the question and then we use that, I would love that. If you don't, that's fine. Just ask the question and email it to us or drop it down on YouTube, and we will certainly get to it. I asked some questions already, and we're going to get right into them probably after the Thanksgiving holiday, but rest assured we will get to them. And also head over to moneyandmarkets.com. That is the flagship. That is where it all starts. Sign up for our free daily e-letter. In that daily e-letter that you get sent to your email box for free every single day of the week, you get safe, sound, smart, simple, profitable investment information for your portfolio from myself, from Adam, from Charles, Chad Stone, Chad Shoup, Mike Carr, a wealth of us. We're all here to make sure we are helping you gain profits in your portfolio. Until next time, this is Money and Markets research analyst and host of the Bull and Bear podcast, Matt Clark, wishing you all safe trading.